There exists a world beyond the glossy pages of Forbes and the shallow sound bites of financial news. A world that operates in quiet boardrooms behind bulletproof glass in Monaco, Zurich, and the Cayman Islands. In this world, wealth is not just preserved, it is multiplied, shielded, diverted, and reborn through a symphony of legal structures, loopholes, treaties, and trusts. It's not just about how much money a billionaire makes, it's about how well they conceal it, how efficiently they avoid taxation without breaking a single law. Welcome to the inner sanctum of the ultra-rich, a shadow architecture where offshore banking, tax-neutral jurisdictions, and sovereign loopholes converge into a seamless art form. Imagine a billionaire based in California. On paper, they seem to own nothing, no direct real estate, no listed companies, not even a car. But in reality, they control hundreds of millions in assets. Prime London real estate held by a Jersey-based trust, luxury yachts registered through Panamanian shell companies, private equity stakes held via a Dutch CVBV hybrid structure, and a perpetual income stream through Maltese pension funds. Their name rarely appears in any public registry, and if it does, it's buried under a multi-layered ownership cascade designed to deflect scrutiny. This is not fiction. This is the playbook of modern billionaires who operate with tools and teams more powerful than most sovereign states' tax authorities. The backbone of this system lies in trust structures. While most people believe trusts are simply for inheritance planning, billionaires use them as both sword and shield. Discretionary trusts in the Cook Islands or Nevis allow them to park assets outside the reach of litigation, taxation, and even ex-spouses. These trusts are irrevocable, protected by statutory non-recognition of foreign judgments, and they can employ protector layers and private trustee companies to add distance between the settler and the assets. A California court might issue an order, but the trustee in the Cook Islands simply isn't legally obligated to comply. The law, in effect, hits a geopolitical wall, but trusts are only the beginning. Enter corporate layering. Say a billionaire wants to purchase a $120 million superyacht. Rather than buying it directly, they establish a Delaware LLC owned by a Belizean IBC, which in turn is controlled by a Nevis trust. The yacht is technically owned by a Liberian holding company, registered to an office that also houses 3,000 other entities. On paper, it's impossible to link the individual to the vessel. The ownership map resembles a spiderweb of nominee directors, offshore incorporations, bearer shares, and legal separation that ensures anonymity and near absolute liability protection. If authorities come knocking, they find nothing, because technically, nothing is owned. This isn't about hiding from the IRS. It's about working around it legally. Billionaires use what's known as treaty shopping, a strategy where they route income or capital gains through countries with favorable tax treaties. For instance, a hedge fund in New York might channel dividend payments through a Dutch BV structure to exploit the Netherlands' vast double taxation treaties. From there, the money might go to a Singapore-based family office, then to a trust in Guernsey, all without incurring the kind of withholding taxes a regular investor would pay. The system isn't broken. It was designed this way by lobbyists and international treaty architects. Where this becomes even more elegant is in the realm of offshore banking. The idea of a Swiss bank account seems old-fashioned. Today's elite prefer Liechtenstein foundations, Singaporean private banks, and Luxembourg-based SICAV structures. These institutions don't just hold money, they manage it, wrap it in protective layers of financial instruments, and ensure regulatory invisibility. With enhanced privacy laws, these banks rarely disclose account holders to foreign governments unless specific thresholds of criminality are met. And since tax avoidance is not a crime, merely a strategy, the veil of secrecy remains firmly in place. Perhaps the most subtle maneuver lies in citizenship and residency arbitrage. Ultra-high net worth individuals often hold multiple citizenships, not just for lifestyle or visa-free travel, but to gain access to specific tax regimes. A billionaire might live in the UK under the non-domicile rule, enjoy residency in Monaco for zero income tax, and hold Maltese citizenship to leverage EU tax benefits. Some go as far as participating in economic citizenship programs in the Caribbean, allowing them to re-domicile entities, shift personal tax status, or bypass EU blacklists altogether. They're not running from taxes, they're dancing through the loopholes with a choreographer's grace. Let's consider insurance wrappers and private placement life insurance, PPLI, one of the most powerful but least understood tools in billionaire tax avoidance. These are specially structured insurance contracts housed in tax-neutral jurisdictions like Ireland or Luxembourg, where the policyholder deposits investment assets under the wrapper. While those assets grow, they are shielded from taxes. No capital gains, no dividend taxes, no reporting. Upon death or liquidation, the funds are transferred tax-free or deferred indefinitely depending on the jurisdiction. To the average tax authority, it's a life insurance policy. To the billionaire, it's an invisible fortress. Even family offices are weaponized in this game. In places like Singapore and the UAE, billionaires establish single-family offices that manage everything from investments and estate planning to lobbying and regulatory shielding. These entities receive tax incentives, often operate without audit requirements, and are strategically located in jurisdictions with little appetite for global transparency initiatives like the OECD's CRS framework. They're not just managing money, they're architecting dynasties that span generations without leaking taxable income. And then there's compliance jujitsu, the strategic navigation of global tax laws through technicality, not evasion. Billionaires often comply with the letter of the law while violating its spirit. They use step transactions, grantor-retained annuity trusts, GRATs, valuation discounts, and intellectual property migration to legally reduce tax liability. A patent developed in Palo Alto might be transferred to an Irish subsidiary and licensed back to the U.S. parent company, converting domestic income into deductible expenses while shifting profits to a 12.5% corporate tax jurisdiction, or lower if double-layered with a Dutch sandwich. To the outside world, this seems like wizardry, but to insiders, this is financial engineering. Quiet, legal, and ruthlessly efficient. They're not escaping tax laws. They're navigating through corridors built into them. Every clause, every exemption, every bilateral treaty has a lobbyist's fingerprint. And the ultra-wealthy know how to read between the lines. They hire ex-IRS agents, former regulators, and Big Four tax architects to ensure every move is above board but below radar. These aren't criminals. These are masters of lawful arbitrage. Perhaps the most chilling realization is that the same governments chasing tax revenue are often complicit in the machinery that allows its escape. Delaware permits anonymous LLCs. The UK allows Scottish limited partnerships to act as shells. The US itself, with states like South Dakota and Wyoming, has become a global tax haven, offering secrecy and protection rivaling offshore jurisdictions. The irony is stunning. The global war on offshore tax avoidance is being fought by jurisdictions that are quietly offering better deals at home. This system is self-sustaining. Billionaires use their untaxed wealth to buy influence, shape regulation, and entrench these mechanisms deeper into the financial ecosystem. The wealth doesn't just hide, it compounds. And as it grows, the capacity to protect it becomes stronger, more resilient, and increasingly beyond the reach of even the most aggressive regulators. If you're wondering why these systems aren't dismantled, the answer is simple. They are too lucrative, not just for the billionaires, but for the banks, law firms, governments, and service providers that maintain them. Offshore jurisdictions generate significant revenue by hosting trusts and corporate entities. They've institutionalized this economy. It's not secrecy, it's an industry. And that industry serves one client, the global elite. This world isn't a conspiracy, it's a code, written in fine print, structured through legislation, and enforced by those who profit from its continuity. It's not illegal. It's just invisible to those who don't know where to look. So the next time you hear about a billionaire pledging to pay their fair share, remember that behind every philanthropic gesture lies a perfectly engineered tax shield. The real wealth isn't just hidden, it's optimized. Not in shadows, but in the footnotes of global finance.